So imagine this. You have spent, I don't know, maybe the last 6 months designing a massive rebrand for a local startup.
Okay, setting the scene.
Right. You hand over the assets, they pay your invoice, you celebrate with a nice dinner, and you just kind of move on to the next project.
As you should.
Exactly.
Yeah.
But then, a year later, you get a certified letter in the mail.
Oh, never a good sign.
No, definitely not. That startup is being sued by some massive corporation for trademark infringement over the logo you designed. And because you designed it, you are named in the lawsuit.
Wow, yeah, that's the nightmare right there.
It really is. Suddenly, it is not just your professional reputation on the line. It's your personal savings account. It's, the down payment for your house. It's your car.
Everything you've worked for.
Everything.
Sure.
So today, we're doing a deep dive into the one invisible legal mechanism that prevents that exact nightmare scenario from completely destroying your life.
And it is a terrifying scenario. I mean, let's be real. But it is also entirely preventable. The problem is that as we look at the landscape of online business right now, in 2026, creators, freelancers, independent consultants, they are making a massive, incredibly expensive mistake.
And it usually boils down to just a fundamental misunderstanding, right? Like a misunderstanding of what an LLC actually is.
Exactly. What it is, how it functions, and crucially, when you genuinely need one.
Well, that is our mission today. We are breaking down the foundations of LLCs for online businesses. And look, if you just heard the letters LLC and your brain immediately prepared for some dry, agonizingly boring legal lecture, just stick with us.
Yeah, please do. We aren't doing that today.
No, we know you already understand the basics of business. You know you have to pay taxes. You know you need clients. We were to go beyond the dictionary definitions today to explain the actual mechanics.
The why and the how of it all.
Exactly. So let's get the jargon and just get right to the concept of legal separation. Like, what is actually happening when you file that paperwork with the state?
So when you file for an LLC, which, just to get it out of the way, stands for a limited liability company, you are essentially engaging in what's called a legal fiction.
A legal fiction.
Yeah, you are creating a brand new legally recognized person.
Okay, wrap my head around that for a second.
Right. So before the LLC, there is just you. You are the business. If the business owes a debt, you personally owe the debt.
Got it.
The moment the state actually approves your LLC, a definitive line is drawn. Your business becomes an independent entity.
Like it has a life of its own.
Exactly. It can open its own bank accounts, it can sign its own contracts, and crucially, it can take on its own debts and liabilities.
I really want to visualize this because abstract legal concepts can get, super slippery.
Oh, absolutely. They blur together.
Yeah. There is this analogy I came across recently in our source material that frames the business as a risky machine.
I love this analogy.
That's so good. So imagine you've built this complex, heavy machinery right in your garage. Without an LLC, you are standing right next to that machine while it is running full speed. You are physically tethered to it.
Right. You're right in the danger zone.
Exactly. If a gear flies off, or, God forbid, the engine catches fire, you take the hit directly.
Which perfectly captures the dynamic, honestly.
Yeah.
Because any commercial endeavor involves risk.
Right.
Taking on a client, selling a physical product, even just offering advice, those are all gears spinning in that risky machine.
So if I'm following the analogy, forming the LLC is basically like pouring a 3-foot thick steel-reinforced concrete blast wall directly between you and that machine.
Yes, a heavy-duty blast wall.
And you can still, reach around the wall to operate the controls. You still collect the product that comes out of it. But if the machine catastrophically explodes...
Which happens in business.
Right, which in the real world looks like crushing debt, a vendor dispute, or, that trademark lawsuit we talked about in the intro. If that happens, the shrapnel hits the blast wall.
It hits the wall, it doesn't hit you.
Your personal assets, your house, your savings, stay completely safe behind it.
And that shielding mechanism is what we call limited liability. That is the absolute primary function of an LLC.
Just protecting the human behind the business.
Right. In fact, that's the entire historical reason this structure was invented centuries ago. It was to encourage commerce.
Really? How so?
Well, society realized that people wouldn't take the risk of starting new businesses if a single failure meant they would, literally be thrown into debtor's prison.
Oh, wow. Yeah, it makes sense.
The blast wall protects the individual human so they actually feel comfortable operating the machine.
Let me play devil's advocate here for a second, though.
Go for it.
A blast wall is phenomenal for a worst-case scenario. Like, if the machine explodes, I am thrilled it is there.
Absolutely.
But catastrophic explosions are, thankfully, pretty rare. For the vast majority of people listening right now, they aren't getting sued today.
Statistically, no, they are not.
So what is the everyday utility of this structure? Like, if I am paying state filing fees and dealing with all this extra paperwork, what is this wall doing for me on a random Tuesday when everything is just going fine?
That is exactly the question you should be asking, because an LLC is not just an emergency ripcord.
Okay.
Beyond that foundational protection, it serves three major day-to-day functions. The first is establishing external professionalism.
Professionalism, okay.
The second is creating internal financial separation. And the third is providing an organization for taxes.
Let's stop on that first one for a minute. Professionalism. I have to be honest, I am a bit skeptical of this one.
Really? Why is that?
Well, if I'm, say, a YouTuber making video essays in my guest bedroom, or I write a niche newsletter, my audience literally does not care if I have an LLC.
That's very true.
Right, they just want good content.
Yeah.
So is this professionalism angle just a psychological trick? Is it just a vanity metric so I can feel fancy and put LLC in my email signature?
I get why you'd think that. And if we were only talking about your audience, you would be absolutely right.
Okay.
Your viewers or your readers, they do not care about your corporate structure. But you have to think about the broader ecosystem of your business.
What do you mean?
The professionalism isn't for the audience. It is for the B2B interactions business to business.
Okay, let's unpack that. How does an LLC fundamentally change how brands and clients interact with me?
Oh, let's say your YouTube channel takes off and a major tech brand wants to sponsor a video. They agree to pay you, say, $10,000.
Sounds like a great Tuesday.
Right.
Great.
But when their corporate accounting department goes to actually process that payment, they have incredibly stringent compliance rules.
Oh, I bet.
They do not want to write a $10,000 check to a random guy named John Smith.
Because it looks sketchy.
It's more than that. It creates huge liability and tax documentation headaches for them. They want to write that check to a registered corporate entity.
I see.
They want a W-9 from Smith Media LLC. Being legally registered fundamentally shifts how external entities view the legitimacy of your operation.
So it actually reduces their friction in doing business with you.
Precisely. It builds instant institutional trust.
That is a really fascinating distinction. It's basically the difference between looking like a hobbyist who might just, ghost them tomorrow.
Yeah.
And looking like an actual peer in the marketplace.
Exactly. But to your earlier point, that external professional image is completely hollow if your internal operations are a mess.
Oh, for sure. Which brings us right to the second function you mentioned, financial separation.
Yes, super important.
Let's go back to that scenario. Let's say that tech brand does write the $10,000 check to Smith Media LLC.
Okay.
What happens if I just take that check, deposit it into my personal checking account, and then use that exact same account to pay for my web hosting, my groceries, and, my Netflix subscription?
Then you have completely defeated the purpose of the LLC.
Really?
Oh, yeah. And you've created an absolute accounting nightmare. Without a distinct business entity, your finances are inextricably tangled. It's what the IRS calls commingling funds.
Commingling funds. That sounds bad.
It is bad. But when you establish an LLC, you unlock the ability to open dedicated business bank accounts.
Oh, so the wall applies to the money, too.
Exactly. All the revenue flows into that specific business account, and all business expenses flow out of it.
Which has to fundamentally change how you understand your own business.
Right.
Like, if your money is commingled, you are essentially just guessing whether you are actually profitable.
You're totally flying blind. Financial separation gives you a clean dashboard.
Right.
At the end of the month, you don't have to sit there highlighting line items on your personal bank statement, trying to remember if a specific Amazon purchase was, a microphone for the podcast or a toy for your dog.
I've been there. It is not fun.
The bookkeeping just becomes starkly clear.
And I imagine that clarity is exactly what makes the third function organization for taxes so critical.
It really is.
But this is the pivot point in our deep dive. When we look at the data and the really common discussions going around in the creator economy right now, taxes seem to be where the most dangerous confusion begins for beginners.
Oh, it is the absolute epicenter of the confusion. There is a deeply ingrained mythology around LLCs and taxes that we desperately need to dismantle today.
Let's dismantle it right now. I am going to throw the biggest myth at you. The tax hack myth.
Bring it on.
I see this all over social media. Form an LLC and pay zero in taxes.
Oh, I hate that one.
Right. The idea being sold is that an LLC is this magical tax shelter. Because you are a business, you can write off your life, lower your tax bracket, and essentially make your entire tax bill just disappear.
Yeah, that is completely false.
Wait, so if I form an LLC, my taxes don't just magically vanish?
No, not at all.
Yeah.
An LLC does not automatically save you money on taxes. It is not a tax loophole, and it is certainly not a magic money trick.
So what is the actual mechanism at play here? Why do people think this?
The mechanism at play is what the IRS calls a disregarded entity. And this is crucial to understand. The IRS at the federal level does not actually recognize a standard single-member LLC as a distinct taxable category.
Wait, hold on. You just said earlier that the state sees the LLC as a brand new legally recognized person.
I did.
Now you're saying the federal government just ignores it entirely.
Yes. This is exactly where the legal system and the tax system split.
Okay.
The state recognizes the LLC for legal liability. That's your blast wall. But the IRS looks right past that wall. By default, an LLC utilizes what is called pass-through taxation.
Pass-through taxation, meaning what exactly?
It means the business itself does not pay federal income tax. Instead, all the profits and losses of the business simply pass straight through the LLC structure and land directly on your personal tax return.
Okay, let me make sure I'm getting this. If my freelance design business makes $50,000 in profit, the LLC doesn't pay a corporate tax rate on that. That 50 grand just gets stacked on top of whatever other personal income I have, and I pay my normal individual income tax rate on it.
Exactly. You report it on Schedule C of your personal 1040 form exactly the same way you would if you didn't have an LLC at all.
Wow. So it really doesn't change anything tax-wise at first?
The structure does not magically alter your tax bracket. It does not create secret loopholes. You still owe the government their share, and you still have to pay self-employment taxes.
Then to be fair, I know there are advanced tax elections.
Yeah.
Like choosing to have your LLC taxed as an S corporation that can optimize some of those self-employment taxes once you're making a substantial, consistent profit.
Yes, that is true. But that is a highly specialized maneuver for way later down the road.
Right, not for day one.
Correct. For the vast majority of people starting out, the baseline rule is this. An LLC provides legal protection, not a tax discount.
Okay, so the tax bill definitely does not vanish.
No.
But let's talk about the legal protection again, because there is a second massive myth here in the source material. The invincibility cloak myth.
Ah, yes.
There is this wild assumption that the moment the state cashes your filing fee, the blast wall is permanent. You are utterly untouchable, regardless of how you actually run the business.
That is a catastrophically dangerous assumption.
Really? Why?
Because the law operates on a principle of fairness. The state grants you this incredible shield of limited liability, but it requires a two-way street.
Meaning you have to do your part.
Exactly. If you want the legal system to respect your business as a separate entity, you have to actually treat it like a separate entity.
So what breaks the wall?
Mm-hmm.
Let's go back to that scenario where I deposited the sponsor check into my personal account and used it to buy groceries.
That is the perfect example of how to break it. If you mix your personal and business funds, if you use the business debit card to buy a personal vacation or use your personal account to pay business vendors, you are actively destroying the legal fiction.
You're tearing down your own wall.
Yes. In the legal world, there is a concept for this. It's called piercing the corporate veil.
Piercing the corporate veil. That sounds incredibly dramatic.
It is dramatic, and it is something every business owner should genuinely fear.
How does it happen?
Well, if someone sues your business, their lawyer's very first move will be to subpoena your bank records.
Oh, wow.
They are actively looking for commingled funds. If they find that you've been treating the business bank account like your personal piggy bank, they will go right to the judge and say, Your Honor, this isn't a real independent company.
They expose the overlap.
Exactly. They say, this LLC is just an alter ego for the owner. It's a sham.
And if the judge agrees, what happens?
The judge pierces the corporate veil. They legally tear down the blast wall. Meaning suddenly the plaintiff can go straight after your personal assets. Your house, your car, your savings, they are all back on the table.
Wow. So the magic shield only works if you meticulously maintain its structural integrity.
Yes, through proper financial separation, keeping good records, and just following the legal rules.
That completely reframes the responsibility. You aren't just buying a shield, you are basically signing a maintenance contract.
That's a great way to put it.
Which leads us to a very pragmatic question. Since the LLC isn't a magic tax loophole, and since it requires strict operational discipline to ensure the veil doesn't get pierced, What happens if I simply choose to do nothing?
The default state.
Yeah. What is the reality of operating without one?
If you start selling a service or a product and you do not file any paperwork, you are legally operating as a sole proprietorship. That is the default state in the U.S.
And the reality of a sole proprietorship is just pure, unadulterated exposure,
Yeah.
right? Like, you are the business.
Completely. There is zero separation. All the income is yours, which, sure, is simple for taxes, but all the liability is yours too.
Right.
If a client slips and falls in your home studio, or a product you manufacture causes an injury, or you just breach a contract, you are personally on the hook for every single penny of damages. You carry 100% of the risk.
So we basically have two distinct realities here. The absolute simplicity and extremely high risk of doing nothing versus the structural protection and strict maintenance of an LLC. That creates a massive timing dilemma. When exactly should someone make that transition? Because you don't want to carry the risk forever, obviously. But you also don't want to take on corporate bookkeeping for a hobby that makes, like, $20 a month.
No, you definitely don't. Timing is everything here. You should strongly consider pulling the trigger and forming an LLC when you hit a few specific benchmarks.
Okay, let's lay out the exact criteria. What's the green light checklist?
First, the business needs to be generating consistent, recurring monthly revenue. We aren't talking about a one-off weekend gig. We are talking about real, predictable cash flow.
Okay, consistent money. Check.
Second, you are actually engaging in formal contracts. Whether you are signing retainer agreements with clients, bringing on independent contractors, or signing commercial leases, contracts mean liability.
Because if you fail to deliver on that contract, the other party has a clear legal mechanism to come after you.
Precisely. They can sue for breach of contract.
Makes sense. What's next?
The third benchmark is that the business is demonstrably growing, and your exposure is naturally scaling up with it.
The machine is getting bigger and running faster.
Right. And finally, you need to have a clear long-term vision. You have moved past the testing or ideation phase, and you are committed to running this as a sustained, ongoing enterprise.
I love that framework. Consistent revenue, formal contracts, scaling exposure, and long-term commitment. But I really want to highlight the inverse of that checklist because it's probably the most surprising aha moment for beginners.
Oh, definitely.
If you do not meet those criteria, you have explicit permission to wait. You do not need an LLC immediately.
That is a vital, vital point. The modern hustle culture out there insists that you need to incorporate, trademark your name, and print expensive business cards before you even launch a product.
It's totally backward.
It's playing business instead of actually doing business.
Well, that's exactly what it is, playing business.
When you are in the early stages, when you are just testing your market, figuring out your pricing, refining your skills, and frankly, making very little money, your singular focus must be on generating revenue.
Build the income first.
Yes. Do not distract yourself with state filing fees and registered agents for a risky machine that doesn't even have a functioning engine yet.
Right.
Many successful creators wait until they make real, stable money. Wait until the business proves it is viable enough to warrant the armor. Let the revenue justify the legal structure.
That is such an empowering takeaway. Like, don't let the anxiety of not having an LLC slow you down or stop you from making your first dollar.
Exactly. Don't let it paralyze you.
Go out there, validate the idea, and build the structure when there is actually something valuable to protect.
Precisely.
Well, we have covered a massive amount of ground today, and I think we have successfully shattered the most dangerous illusions out there.
Yeah.
To pull all of these threads together, an LLC is not a shortcut to success.
No, it's not.
It is not a hack to make your tax bill disappear.
Mm.
And it is not a magical invincibility cloak that lets you run your business recklessly.
It is simply a tool, and like any tool, its effectiveness depends entirely on how the operator uses it.
Right. It's a blast wall that physically shields your personal livelihood from commercial risk. It is a mechanism that forces you to untangle your finances, making your bookkeeping clean and your tax prep straightforward.
Yep.
And it signals to the larger market that you are a legitimate entity worthy of doing business with. It is foundational, but it is not step one.
It is the step you take when you are finally ready to get serious.
Perfect.
And as we wrap up our analysis of this today, I want to leave everyone with one final thought to mull over, something that builds on everything we've talked about.
Okay, let's hear it.
We have discussed the mechanics of this blast wall heavily, right? How it protects your house, your savings, your physical assets. It is a tangible, legal defense.
The ultimate safety net.
But consider the psychological impact of having that safety net.
Psychological impact.
Yeah. Think about it. When you are operating as a sole proprietor, every single business decision is fraught with personal terror.
Oh, totally. Because it's your money.
Exactly. If you launch a bold new product line and it fails catastrophically, you could literally lose your home. That fear naturally makes you conservative. It makes you play small.
Right, you hesitate.
But what happens when you build that wall? When you definitively, legally separate your personal survival from the business's success, does it actually change your mindset?
Oh, wow.
By separating yourself from the risky machine, does it finally give you the psychological freedom to take the aggressive, calculated risks your business desperately needs to innovate and grow?
That is brilliant. The wall doesn't just protect you, it actually liberates you.
Exactly.
It isolates the blast so you can push the machine even harder. It removes that baseline existential dread from entrepreneurship.
That's the real power of it.
I absolutely love that reframing. Thank you for walking through this legal minefield with us today. It's been incredibly clarifying.
Anytime, it was a pleasure.
And to everyone listening, thank you for joining us on this deep dive. Keep building, keep learning, and we will see you on the next one.